Let's drill down further into those numbers, get a sense of what the street is making of that. Sarabjit Kour Nangra, Vice President Research at Angel Broking, joining us. Sarabjit, thanks so much for joining us with your perspective on TCS. You know, we've seen a 3.5% increase in dollar revenues, but if you look at the previous quarters, you've seen about a 6.5% and then a 5.5% in Q1 and Q2 of FY15. And it has come in lower than what the street was working with. I just want your initial comments on, any concerns that you have, because the TCS management is saying they're confident about growth for FY16. So is this going to put more pressure on Q2 as well for them?
Definitely 3.5 vis-a-vis expectation of 4 looks lower. But if you look at the breakup of that 3.5, 4.8% is a volume growth and a pricing which is stable. Now, when I have to look at the overall growth for a particular company, the pricing and the volume growth are more important component. Rest of the components, currency and offshore, onshore components, they tend to vary according to the way the deals move and the way currency movement. So these two variables are not in the hands of a company on a very quarterly basis. So I guess if you look at from that perspective, 4.8% volume growth, which was, if I'm not wrong, last quarter, similar, last Q1 FY15, it was 5.5. So when your industry is likely to grow moderately in comparison to last year, then 5.5 and 5. And last year, TCS also had an inorganic component built in. So if I have to look at all those things in perspective, I think 4.8% volume growth and a stable pricing and a currency which in this quarter didn't play either which ways, neither negatively or very positively, should be a decent kind of a number to work on for the future quarters. And that's why the management is also optimistic and very confident. And if you look at the client addition, that's also pretty healthy. So if you look at these variables, then I don't think there should be a problem in the subsequent quarters.
Sarabjit, I want to pick up on something that the CFO told us in an interview just a while ago. He said that, given the fact that the company is largely going through a transformation phase into the digital push, they're doing a heavyweight training as well of large part of the employee base and largely investing into that. He says margins come second. We will maintain it in the 26 to 28% range that Chandra also told Harsha. But margins will come second. Investment into that technology and into skill development will come first. Does that bother you, considering we're sitting at really close to the end of that range right now for those margins?
See, as I said, currency didn't play much role this quarter in terms of, if you look at on a constant currency basis, which was exactly dollar revenue. So that's just a broader, crude way of putting that the currency had no impact this quarter. And definitely, if currency didn't had an impact, so margins coming at 26.3% with no currency positively or negatively impacting is very positive number. Utilization all-time high, client employee additions happening at a healthy pace, and order book position. I think it bodes well for the company, and definitely such a high margin, such a high operating return on your own capital and higher volume growth, I think bodes well for the company actually.
Sarabjit, when we heard from the management in the previous quarter, they had indicated that Diligenta, they had indicated telecom and, Japan as some of the areas, as well as the energy vertical as some of the areas where they would see concern. This quarter, we've seen telecom hasn't gone up at least significantly. The management, speaking with us earlier, saying that the peripheral markets, and I'm assuming they're talking about Japan as well, could possibly be an area of concern. If you were to pick on one or two of these areas, would you say that you're going to closely watch, any commentary and any movement from those verticals or geographies?
Definitely, see, Japan, in terms of verticals, telecom and energy are volatile. Still the company has done fairly well this quarter by doing both well in this quarter in energy as well as in telecom. Going forward, even they are cautious in terms of these two domains. But nonetheless, these domains, unlike in the case of Tech Mahindra, are not so focused domains for TCS. It's a very well diversified company, and it expects outsourcing in other areas to remain robust. So I guess that should not be such a cause of worry, and even if it is, it's already priced in the stock. If I have to see from the perspective of a price and in terms of our assumption, it's already priced in. So we are not overtly worried about it actually.
All right, Sarabjit, thanks for that. Not overtly worried. I think that seems to be the consensus call on the street right now. It's not great numbers, but really nothing to write home and be worried about. It's passed off from being the worrisome first reporting curse, and the Infosys used to, weigh on that burden a lot more than Infosys seems to have carried out.
They've managed to hold out.
They managed to hold out for now. Well, we'll take a short break.